Hello, and welcome to the No Pricks Allowed podcast with your host, Aaron Buchner from Cactus. I'm Wendy McConnell. Hello, Aaron. Are we going to be well behaved today? I have a feeling the answer is no.
How am I not behaving properly? And what do I do that is upsetting you so much that I'm not?
You talk over me. You don't listen to me. You don't stop talking when I'm talking. You correct me. Shall I go on, or have you been?
Maybe we'll have to have a powwow after this. You'll have to give me the compliment sandwich of all the few good things I do. Is there a couple of good things I do, and then between the things I got to fix?
Very rare.
Very rare. Okay. No, I will do my best to behave. I'm sorry.
Well, I wanted to point out, first and foremost, very exciting day. Now that it's warmer out, it's springtime, you are back to a rock t-shirt.
Yes. No, well, I've got a hoodie on. It's cold here in Canada. I'm a little cold. But yes, no, I have.
It is, but usually you've had like a big...
Oh, a sweater covering it up, yes.
Yeah, you've got the big jumper on.
Big jumper.
Isn't that what you Brits call it? Jumpers?
A jumper. Who wears a jumper? No, I wear a sweater. I don't know. A hoodie. Usually it's a hoodie, but right now it's usually sweaters. But it's colder today. It's sunny. There is no snow outside. So I might get distracted because now I've got a window there that's at ground level. I might periodically look to my side, and that's because a squirrel will run by. So
we have to do something about your distractions. There's way too many of them. Eventually, we will get to the point of this podcast, but I'm not sure when.
Yeah. No, we'll get there eventually.
All right, so let's go there now. What are we going to be talking about, Aaron?
We are going to talk about recession-proofing and market timing because they kind of go hand in hand, because usually people are talking at this time with what's going on in the market and the volatility in the market. People are like, what should I do? Should I change everything I'm doing? Is that the right thing? Should I keep going? So it kind of plays hand in hand with market timing, because that's kind of what it is when you're quote unquote recession proofing, when there really is no such thing as recession proofing. I don't know. I don't think it actually exists. I think it's just a scam by people who do it on social media, say, here's how to recession proof your portfolio. You can't recession proof a portfolio. I'm sorry.
When you're talking about investments for the people of your country, of your homeland, Canada, are you investing in the U.S. stock market, or do you have something else that you're investing in?
No, they're investing in the U.S. stock market as well as the Canadian, as well as the European. So anything.
Okay, so it's all diversified.
Yes, it's always diversified. That's always the goal of anything we do, is it's always globally diversified between Canada, U.S., Europe, and different portions into each. So yes, us in Canada, we can buy U.S. stocks and U.S. funds and those types of things. So we have mutual funds and indexes similar to what you have that match the U.S. stock market as well as the Canadian and the European.
My thought process was like, I know the Nikkei is something completely different, and there's another one that's completely different. So you're talking mostly about like U.S. stocks and such.
It's still U.S., but
for the most part.
Most part, but everything I do, anytime we invest with a client, it's always globally diversified. Primarily, okay. U.S. takes up the largest portion of it because of the companies and the size of the stock market. The U.S. stock market does take up a larger piece of the overall portfolio, but then there's a piece that's still Canadian, there's a piece that's Asian, there's a piece that's European, so they're all kind of in there together working.
But overall, you're watching our stock market and sometimes panicking like we are here. Is what the question is.
And they all kind of do the same thing. When one goes down, they all kind of go down.
Yes.
I don't panic so much. It's just, okay, I have to go then on, which I've been doing for the last 2 months, has been constant webinars of what is happening in the market. What do they think is going to happen? Constant learning of what is going on, because everyone comes to me and go, what's happening?
Panic was my word.
Yeah, panic's your word. I don't panic because I'm like, okay, like everything else, we're investing as a long term. So we shouldn't panic because we're looking at the long term. Yes, you have bad years. You also have great years. The hope is you shouldn't be panicking and then having these conversations of, what do I do? Do I get out of the market? Do I stay in the market? How does that affect? Should I pull out? Is it going to go? And the questions just go downhill from there of if I know anything, but I don't know anything.
Oh, well, I knew that. So without with giving regard to the fact that nothing is recession proof, how do we recession proof?
Like I said, there is no true recession proof. Like, I think that's just a phrase that's put out there. You really don't recession proof a
Kind of
portfolio.
a joke,
It's
but all right.
well, I think it's just a way to people to get eyes on your material. So it's content marketing. I know it's out there. It says, oh, there's like 10 ways to recession proof your portfolio. But if you have a solid plan in place that looks at who you are, your priorities in life, the amount of money you can put in, the timeline, your risk tolerance, you shouldn't be changing anything. There shouldn't be anything you're changing in that investment structure because you're already set up. When it's set up properly, this is what you should be invested in for 30 years. It's not, this is what you should be invested in for the next 3 years until a stock drops and negatives start happening and then we're going to change everything. It's like, no, you're just looking at and going, okay, my time is this. This is the fund I should be in. It's going to go down sometimes. It happens. Go through the market. They go up and down all the time. So recession proofing, there is no recession proofing of an investment portfolio. You can recession proof your lifestyle depending on where you are. That I agree with. Like if you're in trades and they're going to be possibly be dropped down where they're not building as many houses or doing as many construction projects, or you're working in factory jobs that are being hit by it, you can recession proof your lifestyle by saying, okay, I possibly need to put more money into an emergency fund because I might be out of work longer than just 3 months. It might be 6. So I need to put more money into my emergency fund. And that's the type of stuff you can really recession proof or look at and say, okay, where is my money going? Because I know we're going to have to cut back. Maybe now we're not doing dinners out or those little things in life.
Okay.
But an investment strategy, you don't recession proof, but your life, you absolutely can recession proof your lifestyle.
So should we be investing at all? That is the big question. And I know that you're going to say yes, so let's go.
Yes, people always want to know, okay, is it the right time? Because the market's going down. Should I put money in? And there's never a right time, like quote unquote, kind of like we don't know when's the right time to put in. We can say, yes, you should invest on this day, but we don't know because no one knows what's going to happen day in, day out. I think a lot of it is if you're investing as a first timer, it can be difficult to put money into an investment and watch it go down. Like that, it hurts. And losing $50 may not seem a lot for some people, but if they put $1,000 and they lose $50 in the market, it hurts. And we know psychologically it hurts a whole lot more to lose $50 than to gain $50. So I think a lot of times people don't want to go into the market because of that initial impact of, oh, I'm going to lose $50. Like I'm putting $1,000 in and now it's only $950. And so I understand that psychologically emotional drag on it, but you have to remember it's like you're not investing just for the next week. We're not doing short-term investing. We're not trying to find the next stock that you're then going to sell in 2 weeks because it jumps up 10% and then switch to another. We're not day trading here. We're buying funds and in companies and stocks that are going to grow over the long term. We're looking at 20, 30 years of growth. So yes, you're going to have these small downturns, but they're going to start going up in the long term.
So what about Warren Buffett?
I think this is my opinion. I don't like the one. He has that one quote of I have it on my screen, so I got to read it. It's being greedy when others are fearful and fearful when others are greedy. And that just talks to the market. There's indexes in terms of fear and greed. And usually when the markets go down, people are fearful. When the markets go up, people are greedy. And he says, okay, when people are fearful because the market's going down, that's when you should put more money in and you should overinvest. But
okay,
if you're not investing regularly anyways, and you're then sitting on this pool of money and say, no, I'm going to invest it when people are fearful, I'm like, you're timing the market is what you end up doing. And we know you can't time the market. There's tons of studies out there that says no one knows when the right time to invest and the best times to do it. So you can't say, oh, this is the right time to put it in because everyone's fearful, I'm going to buy more. You should be doing just a regular investment cadence based on your lifestyle, not holding on to this pocket money in cash for this fearful moment to invest. We are not as smart as the people who or doing this on a regular basis. Like the people who own portfolio managers and are buying and selling stocks, I'm like, they've got teams of 50 people who've gone to like Harvard and Yale and all the top schools and have computer programs and AI and all this stuff. And you're just sitting here looking at a screen yourself. I'm like, you're probably not going to be picking the market faster than them. They're most likely going to beat you because of everything they have. So I don't look at it and go, you shouldn't be investing more because people are fearful or investing less because people are greedy. You should just be constantly putting in money at the proper cadence and the proper fund based on what you need to achieve.
Okay. So let me ask you a question. I have a bunch of high risk tech stocks, which I've just found out is really what's really kind of driving the market down right now. Should I sell those even though they're down and get into lower risk stocks, or should I ride it out and hope they come back up?
Once again, we're talking about timing the market. Like it goes back to this.
Well, yeah, I want to do that. Let's go. Tell me what to do.
Should I pull it? Well, depending on, I'm going to assume you have a perfect portfolio built around you. You have some tech stocks, but you're globally diversified, right? You've made all the right choices, but
all tech stocks.
It makes sense what you're saying, that logically you would think to yourself, okay, these tech stocks are dropping. They're higher risk or higher volatility, which means, yes, they can get a plus 20 or a minus 20. So you're thinking in your head, okay, if I pull out of them and I go into a lower risk fund that only does like a plus 5 or minus 5, I'm not going to lose as much money. Like that's probably the process going through your head, right? If I make sense to you?
Yeah.
Yeah, makes sense. Okay. See, look, I do know some stuff, you know.
Well, I don't want to sell and lose money, but I don't want to stay and lose even more money.
So it makes sense why you want to do that, but it goes back to that time in the market and there's studies out there that just missing the 10 best days in the market almost drops your return by 50%. So there's a 50%
So you're
drop.
telling me to stay?
I would say, assuming that, like I said, I'm taking that hypothetical picture that you have properly invested based on your risk, your tolerance, your lifestyle, based on your goals, it would be ride out that blip, ride out what's going to happen going forward. But if you're looking at it and you're panicking, like freaking out, going, oh my God, what's happening? I'm losing money, and you can't sleep at night, you probably need to reevaluate what you're actually invested in. So it may be the right time to say, okay, maybe you shouldn't be so heavy in these tech stocks because they're taking a huge dent out of your portfolio. Maybe we should look at something that's a little bit lower risk, but is still in view of your long-term goals for the long term, because there's still risk to everything. Because yes, tech stocks are higher risk because of the volatility, but when we talk about longevity risk, doing GICs or bonds, I think they're called CDs in the States, they're the longevity risk hurts you more because lower return, yes, you don't get the fluctuations, but a lower return that gets eaten away versus those tech stocks, yes, will fluctuate up and down, but in theory will generate a higher return and perform better over the long term, assuming you hold on to them.
Okay, so moving from stocks to bonds, that you're saying that's like the same idea as selling stocks and moving to cash. What does that mean?
It's timing the market. So it's the same thing. So bonds are when you look at the market, we talk about equity or like equities or stocks, which are your companies. So we're talking big name companies for ease of purposes. So we're talking about the Metas, the Visas, the MasterCards, the Googles. And then you're talking about bonds, which are which in our case we call them GICs, guaranteed income certificates that provide a certain level of return for a set period of time, but they're lower risk because, okay, yes, you're going to guaranteed 3%, so you don't have the volatility, but over a long term, they don't perform as well.
That makes sense. Doesn't make me feel better, but it makes sense. So can we go higher risk and then generate even more money?
And people will do that assumption too. It's okay, well, if I invest in the tech stocks now when they're down, I can put more in and I'm going to get greater returns. once again,
if they go up.
Yeah, if they go up. And the theory, like logically, it makes sense. I'm like, wait, I was buying them at this price. I was buying them at 100. Now they're down to $80, but the projections should still be the long term. I buy them at 80. I get more stocks. Therefore, I can generate more cash over the long term. But it goes back to, what is your risk tolerance level? Because if you're dumping more money into the stock market in these higher risks, you now are possibly taking on more risk than you should have initially, based on all the factors we talk about, priorities and your risk capacity and composure. That's where we get into those things. So I don't think for a lot of people it's not a smart thing, especially if you're thinking about gambling. I'm going to call it gambling at this point. Of, you're saying, you know what, I know stocks are down, but they're going to go back up, so I'm going to take extra money that I wouldn't normally have invested, and I'm going to start putting it in there. I probably wouldn't do that, because you've had this portfolio and this plan in place for a reason. It was set specifically for it. You're now changing the plan because now you're going higher risk. You're taking money away that you possibly need to live on a regular basis. I don't think my wife would be happy if I say, you know what, we're not going out to dinner this month because I took that like $200 we were supposed to and I bought stocks. I don't think she'd be happy with me on that case. Even if over the long term, I'm like, I still think she'll want to have that dinner out, and I want to get the dinner out, get away from the kids. So definitely don't take extra money and go, oh, I can make more money and I can do this and I can buy more stocks because they're going to get greater return and I can generate more money. And I almost think if that's your process in your mind is, but if I buy more now, I can get more money, your plan probably wasn't correct to begin with, because you're now initially thinking to yourself, like, I need to generate more money because, well, why do you need that more money? Is it because now you don't want to retire at 65? You want to retire at 62? So, okay, well, your plan is now everything you've invested in is wrong. So yeah, we have to change everything for it.
Okay.
You have to think about what's the rationale. I'm thinking in my head of, I want more money. Why do you need more money? Because X reason. I'm like, oh, your plan was never right for the initial impact.
You have to reassess the whole plan.
The whole plan. Because yeah, we did it based on, if we had the initial discussion and you said, okay, I want to retire at 65 with $1 million. Okay, well, here's the plan. This is how we're going to do it based on these funds, this amount of money, this time frame. This is how we can best do it based on your situation. And if you're looking at the markets are down and you're calling me up and saying, Aaron, the markets are down, I can put in extra money and I can get more money and generate more. And I'm like, well, why do you need more? Because you said you only needed this much in 65. What's changed? Something's changed in your lifestyle now.
We want more, Aaron. Of course we want more. We want more.
Yeah, I know. You know, a helicopter in my backyard's not going to make me more happy. Like, yeah, a cool thing to look at, but I'm like, I don't need a helicopter. It's going to be, what's your lifestyle?
Well, that's a whole different discussion. So tell me, Aaron, what is going to happen?
I have no idea. I don't know what's going to happen. No one knows what's going to happen. And I think that's the one thing. Everybody kind of say, well, I go to these webinar things where they're talking about what's going on. And I think the first question every single advisor pops up is like, what's going to happen? What's the market going to look like for the next 5 years? Or what's the year going to look like? Is it going to be higher or lower? Because for whatever reason, they're worrying about this to have these conversations with their clients. And I'm like, they've learned, I think, some of them to say they don't know. They have no idea what's going to happen over the next years. They don't know if the market's going to go up or down, because a lot of the market nowadays is just driven by behavioral emotions. Individual people are putting money in and doing this buy sell, that you can get these fluctuations in stocks. They don't know what's going to happen. They don't know what the US is going to put out there now in terms of tariffs and what could go in place, not go in place. They kind of have an idea, if they go in place, what can happen to the market. They have a little bit based on historical data, but they still don't know. Like, it reminds me of, I think it was the first time I learned all this when I went through it, was the first time Trump was elected. We had all these webinars beforehand and people were like, what should you do? And all the managers were saying, well, get out of the US. They thought, like, don't go in the US. Like, we don't know what's going to happen. It's not the right thing. So we were scaling back people out of the US who were in retirement to make sure they didn't have these high fluctuations in their market. And we went, okay, let's go heavier in Canada, a little less in US, and did this. But then the US went up. And then for the 4 years, I'm like, the returns on it were great. but we all thought, oh, it was going to be bad. So it's like, no one knows what's going to happen. I don't know what's going to happen. I can't sit here and say this is the return for the year or not. And that's why we can't time the market. We can't say, yes, pull out of this and buy these because the market's going to go down. I don't know when the bottom and the top is. No one knows. I don't have a crystal ball. I haven't found that on Amazon yet. I don't know. Is it you've stopped doing Amazon? I haven't found one on Amazon yet.
I did stop Amazon. I'm so proud of myself.
Oh, good for you.
So tell me, without actually recession-proofing our investment, our portfolio, what do we need to do to make it, as less volatile as possible, I guess is the way to put it?
The volatility in it is going to go back to what is your risk tolerance? What do you want to do? What makes sense for you? And what you're trying to do. We can't stop the market from going up and down. We can get we can get rid of it and say, okay, go 100% in GICs, but then you're gonna have to put a lot more money into those accounts versus what you probably should. So I think a lot of times if you're looking at your portfolio and things are kind of worrying you that they're going down, you need to think about the long term. It's that fact of, okay, do you believe though over the next 20, 30 years, things are going to get better? Yes, right now it's going down. Yes, you see the money going down, but in theory, it should go back up. I can't guarantee when, but in theory, it should. But definitely pulling out of higher returns and going lower returns for the set time is not going to be the smartest move. The best thing is to hold on tight to it. But if you're having those freakouts, it's okay. Sit down, reevaluate what you're actually invested in and what is it that's actually driving this fear in the market and concerns. What is driving it? Because something's driving it psychologically in you of why is this a concern for you? What is it? Is it just a worry you don't believe the markets are going to go up? Is it just the fear you're seeing the money go down because you actually want the money sooner than you initially planned on it? What is that why that's pulling from you? So we have to look at that and take that step back and figure out what is the issue.
Yeah, it's funny because, now is a time when you kind of really figure out what your tolerance is.
Yeah.
With everything that's been going on, all of a sudden, you're not supposed to look every day, but if you are and you're upset, maybe your tolerance isn't as high as you thought it was.
Exactly. And I think everyone usually predicts their tolerance level is far greater than it is because we've talked about in the other podcasts about your risk tolerance, your risk capacity. And I think a lot of people, it's going to depend on the mood of that day. When the stock market is doing great and things are going up, your tolerance is a whole lot more. All in. I want the high. I'm not going to get the -10. I want the +20. But when you get that -10, you're like, no, I don't want to lose anything. The tolerance changes. So it becomes that thing of tolerance is just a gauge of that moment, that day, how you're feeling, but your risk composure of when this actually happens, that's the true indication. When people are starting going what do I do? How do I handle this? Oh my God, money's going down. It's okay. This is where you have to reevaluate and go, something's wrong. Something's affecting you to have this negative reaction, to want to stop and reevaluate what you're doing. So I think it's mostly people probably went a little bit higher risk than they wanted to. And now it's oh, shoot, it's not there. And okay, let's scale it back then and set it properly.
Right. So we can't really recession proof our portfolio, but we can, as you mentioned earlier, our budget. That is the thing that we have control of, right?
Yes. And you can only control what you can control. And when you talk about investing, the only things you can control are what are your priorities, what do you want to achieve, how long you have, and how much money you can put in. The stock market, we can't control it. It's going to give you what it gives you. You can't change it. You can't predict and say it's going to give you X dollars no matter what, because we don't know that's going to happen. So the key thing is, if anything, if you're looking at recession proofing and how do I improve my situation, it's focus on your life and what can you do in terms of padding that emergency fund if you need to, improving your education so maybe you move into different jobs, finding other career paths that pay more money, finding ways just to save money in the end for yourself, because that's the only thing you really can do for recession proofing.
Yeah. All right. So Aaron, if people have more questions, and I'm sure they do,
They do.
how do they get in touch with you?
Easiest way is through the website at prickfree.com. And then I'm also on the social medias. I'm talking about this stuff a lot on social medias right now. So I'm all over LinkedIn, Threads, Instagram, and Facebook.
All right. Sounds good. Well, thank you so much.
You're welcome.
Thank you for letting me talk and not talking over me, except for right now.
I'm just, I get really, you're going to end on that note. All the stuff I talked about, you're going to end on that note.
It was very informative, very helpful, and I appreciate it.
Thank you.
Is that better?
Yes, that is so much better, Wendy.
All right. Thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time.
Thank you for listening to the No Pricks Allowed podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.prickfree.com or give us a call at 613-876-9899. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Cactus. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The contents of this podcast do not constitute an offer or solicitation for residence in any other jurisdiction where either Aaron Buchner and/or Sterling Mutuals is not registered or permitted to conduct business. The opinions expressed are those of the authors and do not necessarily reflect the views or opinions of Sterling Mutuals, Inc. Mutual funds provided through Sterling Mutuals, Inc. Commissions, trailing commissions, management fees, and expenses all may be associated with mutual fund investments. Please read the prospectus carefully before investing. Mutual funds are not guaranteed, their values fluctuate frequently, and past performance may not be repeated.